Hello, welcome back. In this video, we examine the dividend stocks and the growth stocks. What are their characteristics and what we can expect from them? The chart shows the x-axis as a percentage of total return from the capital gain. Those who are higher and closer to the x-axis are the high growth stocks that do not usually give dividends. The y-axis shows the percentage of total return from dividends. Those closer and higher on the axis are dividend growth stocks and REITs. Adding the coordinates of x-axis and y-axis will give the stock's total return. The next group is dividend trap. They do give dividends regularly, however, their share price keeps declining more than offsetting the dividends, resulting in a net loss to shareholders. The last groups are laggards that give a bit of dividends and little capital gain. They underperform the index. Here's a sample of companies with their total shareholder returns measured over the last 5 years from 2018 to 2023. The first group is a group where more than 20% of the returns are from dividends. It's a mix of dividend growth stocks such as SGX and Sheng Siong, and REITs such as Mapletree Industrial and Mapletree Logistics. The second group consists of dividend traps like SingPost, ComfortDelGro, and Singtel. They pay regular dividends, but their share price declines so much that they result in a net negative returns for shareholders. The next group is growth companies. Here we have the global companies such as Visa, Microsoft, and Alphabet that have achieved multi-bagger returns within the last 5 years. Here are the companies presented differently. Do pause the video to examine the graph and numbers. The first group presented earlier is split into two groups, companies and REITs. Generally, dividend growth companies generate more capital gains compared to REITs. The next group is companies with net losses. There are also many REITs in similar situation. The last group is the growth company that are all about capital gains. Here is a snapshot of their financial numbers. Again, pause the video if you want to examine it closer. Notice some characteristics among the different companies in different groups. The dividends trap share quite similar characteristics. Revenue decline, net income decline, margin decline, declining free cash flow, and low ROE. Those that achieve positive total returns have revenue growth, profit growth, margin stability or expansion, high ROE, growing free cash flow. The higher the growth in revenue, profits, and margin, and the higher ROE, the higher the total returns. High growth companies like Microsoft, Alphabet, and Visa are in good position to pay good dividends. However, they choose to hoard cash and go for R&D and acquisition where opportunity arise to keep growing. They do not give dividend, little if any. How do we broadly categorize the companies? The high growth companies have the world as the market. They have a high barrier to entry. They keep innovating and introducing improvements and new services with minimal cost. This helps them to keep growing well. Let's look at SGX, Sheng Siong, and DBS. They have a good moat in what they do within their geographic focus. They keep growing with new and better services and keep inching their geographic coverage to grow further. Rich growth is a function of its high quality assets and debt and equity management. The ability to grow is to identify good assets at a reasonable price to invest and yet be prudent in using debt and equity. Yes, they used to be investor favorite and many still do because they have exclusive licenses and concessions from the government that allow them to make good money. However, they are battling with disruption and changing consumer preferences. Their positions are challenging and being threatened as we saw from their financial performance in the earlier slide. So we must always validate the stories and the strength of its moats with the financials. What is relevant and attractive today may not be tomorrow. Things may change, do not assume always validate. Very few companies listed in SGX can deliver long-term consistent growth. We have seen what happened to companies such as SingPost, Singtel, ComfortDelGro, and many REITs as well. It is a difficult feast. To emphasize again, always validate to hold long. Do not buy and hope or buy and forget. Another thing to do is to look beyond those listed in SGX to those in US and Hong Kong to find great companies. Many feel safe investing in SGX, but it is just a home bias that we have. What do we want? Regular dividends with capital gains, or do we want to go for capital gains? It is a trade-off. Growth companies that keep cash and do not distribute as dividends. If they can be proven to be a good capital allocator with their consistently high ROIC, more cash at their disposal is good and shareholders should be assured that they will do well. REITs have the mandate to distribute their cash for dividends, while dividend stocks are okay to use a large portion of their cash as dividends. Shareholders should always hold on to the best company for more returns, but they must keep validating to ensure that they stay competitive. Lastly, for those dividends trapped, we have to assess whether they can still be relevant and competitive, and whether we are better off selling them to buy better companies. In short, investors should not be too focused on just dividends. Focus on the quality of the business and its potential. Always focus on the quality of the company for total return, their ability to keep growing. Choose only the best. Choose those with good consistent dividends policy if we decide to go for dividends. Be tight in your criteria and be hardworking to keep validating their quality and ability. That's all I have for today. Thank you for watching. Do have a profitable journey ahead. Do give a like and subscribe to the channel for more such content.